Today, the latest from TickTock. Hello, I'm Martin North from Digital Finance Analytics. Today, I'm talking to Anthony Baum, the CEO of TickTock, and we're going to hear a little bit about their business and some news that they've got to release today. Hello, Anthony. Good to catch up with you.
Thanks, Martin, and thanks for your time.
I think a great place to start would be just a little bit of background on TickTock. You've been developing this business model for a little while now, and it's going very well, isn't it?
It is. Thank you, Martin. And look, TickTock is a instant home loan platform, and by instant we mean you can be fully assessed in real time through the application process. The exciting thing about that is it does two things. One, it enables us to customize the customer experience for their circumstances. And secondly, it obviously is highly efficient from both a customer's time and effort perspective, but also from a cost of origination perspective. And, our objective is to use that savings to the benefit of customers, both ours and our future white label partners.
And you're talking about an ability potentially to do a lot of the heavy lifting in 20 minutes, is that right?
That's right, correct. So through the application process, it's basically a 5-step process. The first is we look at the property for eligibility. The second is we then look at your circumstances and conduct a responsible lending assessment, at the end of which we display eligible products. Then we only when you're happy with the amount we'll lend you against the property and the product for which you will be assessed. We then go through a personal financial and validation steps to enable us to complete the process. If at the end of the process you're fully digitally assessed as approved, then basically we'll validate title to person to property, and then we'll send you your docs at the end of the process.
So it sounds a very different process to the typical broker origination process that we'd see, for example, attached to the major banks.
Absolutely correct, for two fundamental reasons. One is effectively, if you go to a broker, there's two processes. There's a process with the broker, and then there is a process with the bank. The bank, will complete its full assessment through its workflow post the application being submitted by the broker. Our process is one that is happening in real time, and we are authorized to fully approve you through our technology, or if you're not instantly approved, to assess you for the balance of items that we need to validate to complete the application assessment. And, even if you're not instantly approved, which, the vast majority of customers aren't, because they don't actually have the level of understanding of their financial position that completely requires. Lots of customers are fully approved and have their docs within an hour because they've forgotten to add a credit card is a good example that they hardly use, but there's a limit on. So there's always, not always, but in a vast majority of cases, there is a little bit of follow-up. But really, we're here 7 days a week. They get turned around by the assessment team. They're underwriting on a what's called exception basis. So they only need to look at those specific rules that our technology is telling them they need to look at. And that's really powerful. And makes us an extremely efficient assessment platform, but also a really good customer experience, because you get contacted once. These are the 3 things we need. You understand that. You're sent a link. You can send those to us. You can add that bank account, and the system will fully reassess you. So it also deals with the risk that compliance with the responsible lending obligations in spirit, not just in law, are very well covered by our platform, And we're trying to set really strong benchmarks there. When you digitally assess, and you choose the fast way, which includes an extract of your bank account data, we fully assess that data for up to 365 days. We validate your income, we validate your expenses, we categorize your expenses, we can talk to you and make sure that discretionary expenses are truly discretionary if you're referred because of your expense base through that process. And we're very proud of the lending standards that we're implementing, and we think, frankly, the technology's there to assess the way we do. The industry should be using it.
So that you make really two very important points. The first is the improvement in customer experience, and secondly, the leveraging of the digital platform from end to end, which gives you perhaps a more accurate assessment, a quicker assessment, and therefore takes a lot of the risk and noise out of the process.
Absolutely, and more cost effectively. We estimate that our origination costs are up to only about a tenth of a bank's.
Wow, that's a huge difference there. So what are you seeing in terms of, there's been a lot of focus in terms of lending standards and particularly expenses analysis, and, people are being asked to jump through very painful hoops now with regard to disclosure of their expenses. In fact, I did an article recently about the fact that a whole lot of people now are being rejected because they can't actually provide the data. Right. So what are you seeing?
What we're seeing is exactly what you've said. The reality is that ironically, the current macroprudential measures and lending standards that in aggregate society's expectations today, and should have been in place for a long time, frankly, have resulted in a lot of customers being in the circumstance where they are effectively, as you called it, captive to their current lender. Now, what's worse is we're seeing behaviours where those lenders are exploiting that fact. They are charging existing customers high rates and then offering really, really, really aggressive rates to new customers that are eligible for the new rules. We have in our principal and interest customers, owner-occupied, between the highest rate and the lowest rate a customer pays is 0.12%, 12 basis points. And that's just purely due to origination cycle timing and rate positioning in the market. We would love to see that we're able to do two things. One is that actually look at a customer's existing borrowing position, and if they have been previously approved and it's within certain parameters, actually to offer them lower interest rates because it will help them pay their loan down on a P&I basis and help unwind that risk in society. We think that is a really good idea. That the capacity for banks to, in effect, discriminatory price good customers that have been paying, but they lent too much to, based on the current rules, that should be looked at separately, because we're quite passionate about ensuring that customers are fairly treated, and ultimately long-term processes like ours will mean the convenience of being able to refinance and bring competition to the market is real. But at the end of the day, we still need to comply with the responsible lending standards and make sure we're not over lending. And so, that's probably our biggest challenge to that at the moment. We've seen amazing growth in application numbers, but we've also been very transparent that, and it obviously has increased since our last stats, but we've been very transparent that we've assessed $1.3 billion of customers for a loan portfolio of $200 million now. Why is there that differential? One is timing lag, because customers take time to be refinanced, and there's quite a lag in banks actually releasing their existing customers, sometimes 2 months to 3 months. before they actually let them go. But the other thing is that we have, in reality, seen our strong compliance with the regulations resulting in a lower approval rate than those customers probably deserve. But it's to do with the fact that they've been overlent to in the past through irresponsible lending practices.
So you're certainly seeing evidence, as came out in the Royal Commission, of people getting loans they probably should never have got. And so we've got this sort of legacy question now of people who had loans previously
Yeah, how do
and
we
now
help
struggling.
them?
Yeah, exactly. And that seems to me probably the biggest conundrum for the industry, isn't it?
I believe it is. And that's why we're calling for specific rules with respect to the refinancing of borrowers whose financial position can be demonstrated as not materially different from when they took that loan out in the first place. If it is resulting in effect, a strategy that reduces their repayments and helps put them in a better financial position and more able to prepare themselves for, the potential rate rises that are to come in the future, which we'll talk about later, I'm sure. But, we do see that as something that could be done to promote competition at this point in the cycle.
That's very interesting, but that would require a significantly shifted mentality amongst the major lenders, right? Because what they're doing at the moment is chasing the lower risk new business and offering very, very cheap loans. But there are a lot of people who are locked into higher risk, higher rate loans because perhaps there's a slightly higher risk. And it's almost as if they're trying to protect that back book.
Absolutely. So we want to promote competition. We want to, let's face it, we want to break the competitive advantages, both regulatory, capital-based and onwards, that the major banks have that have resulted in their market share increasing significantly since the GFC. And what we just talked about is an absolute brilliant example of how we can stop them actually being rewarded for the bad behaviours of the past and the overlending of the past, driven by in part the favourable capital treatment that they received over everyone else that gave them lots of capacity to increase the size of their home loan books, with a single rule set around borrowers that are existing borrowers in the circumstances we just articulated. You would prevent them from doing exactly that, because unless they either price those existing customers more towards where the new customer market is, then those customers ultimately would have the capacity to shift, which is, really what they are looking to do. I'll go back to our stats. Our stats are driven by that. The single business rule set that is most likely to fail when a customer applies with TickTock is actually that rule, is that serviceability rule set associated with responsible lending provisions. And actually, we use actual income, we use the higher of validated, stated, or HEM adjusted as an absolute floor that we do not go below. Believe you me, if you truly inquire into customers' circumstances, it is only infrequently that they actually can demonstrate a number below that, but we still use that as the floor. And that practice results in what we're seeing in those stats. So they're still not, they're current customers. They're desperate to be good customers, but if they're paying 1 to 1.5% more with a major bank because they're being effectively locked in, then we're not actually helping them get out of that over borrowing situation at all. In fact, what we're doing is we're locking them into it, and as a result, at the same time, the major banks are benefiting through higher profitability. You know, it's and actually enhancing their competitive position, as we've seen by them being the only institutions that have not passed through any of the increase in funding costs experienced by the industry.
Yeah, absolutely. And the other interesting observation that I've got is that we've now got brokers who are trying to assist potential applicants by shaping their expenses, you know, so effectively helping them to declare expenses in a different way to try and squeeze under the hurdle.
Yes, I think what's really important is the requirement is to validate the customer's expense position. So that should be done by the lending institution ultimately, because the lending institution should be responsible for that assessment. Outsourcing of the customer assessment when it is not the ACL who is responsible for the lending decision, which in our case is us, is problematic because you will always, we're at risk of seeing another variation of the same problem, which is educate the customer to get into a position where they can get a loan that maybe they shouldn't. So if it's a refinance, then that's interesting because we're back at how we deal with this issue of helping customers reduce repayments, get their principal balance down to a prudent and safe level while interest rates are still low. But we've got this issue of exactly what you said, which is that the new rules have come in, but they're only really effective if you're actually using the technologies that are available to do really diligent validation of expenses in particular, because they're the complex ones. Income's easy. You can validate income for 6 to 12 months for most customers digitally within pretty good tolerances. It's the expense and undisclosed liabilities that are the two biggies.
And the concern that I have is that we're just seeing a repetition. Effectively, the rules have changed, but effectively the fundamental behaviour hasn't necessarily changed from the vast majority of participants in the industry, and therefore we haven't solved the problem of bad lending. We've just moved the goalposts.
Well, you're probably better placed to comment on that than us. We're pretty passionate about what we do, and we know it's possible, and we do it. And we've heard statements that it's too hard. It isn't. It isn't too hard at all. It's nonsense. The technology exists. We've developed it. We have an amazing internal technology we call TY, which basically can take all that data. It can validate the customer across a whole range of business rules in real time. Those rules cover income, they cover expenses, they cover currency of their loan repayments across each loan type. They deal with payment timing, so monthly, weekly, fortnightly, half yearly. We find undeclared liabilities through being able to take regular payments to institutions that aren't declared through that process. And if something changes through the assessment process, we can rerun all of that to make sure that actually it's the final validated position of the customer that is actually being used in the assessment. And that technology we've developed, if we can do it, the major banks can do it.
If they choose to.
You said it, not me. So, yeah.
And so just you touched on the interest rate rise question, and I guess I'll be interested in what's your perspective as to how the industry is going to play out over the next 18 months to 2 years?
Well, I think the key question is normally what would happen if you have the events of the last few months where BBSW has risen materially. For a long time the 30-day BBSW sat at, around 10 basis points over the cash rate. We know that around half of banks' funding and certainly all of the securitizers' funding is based on the bill rate, BBSW. We've seen the BBSW 30-day rate as high as 2.1% in the last few months. And last time I looked, which I think was last week, it was sitting around 1.88, which is still a 38 basis point premium to the cash rate. Now, typically when that happens, what would happen is those big four banks would move first. They would increase their customer rates across the board, and the industry would follow. For reasons that we can only speculate about, and you're the independent commentator, so I'd prefer that you do that than me. They have elected not to do that, and in the case of selective rates for the high quality new customers, P and owner occupied, what they've actually done is reduce their rates to almost best in market. So what they've done is, in effect, through I would say their capacity to manage their profitability across the board by potentially charging existing customers more or a premium for some of the reasons we've talked earlier, plus, funding, making up margin elsewhere. We've seen a number of reduced deposit rates, actually not produce what you would expect, which is actually a bit like petrol prices. When oil goes up, petrol goes up. When the cost of funds goes up, if you have a ordinary, properly performing market, then that was truly competitive, then actually you would see customer interest rates go up, because funding costs gone up, customer interest rates go up. The majors, because of their market power, have been able to avoid doing that. So what that actually means is we're at risk, actually, ironically, that in the current environment, the four organisations that we are seeking to not be in a position to over control the market and have genuine unfair market power and influence, actually are currently winning. They're winning from the market circumstances, and that's ironic in many ways, given the findings of the Royal Commission and the Productivity Commission. And it's kind of sad, isn't it? But so our response to that has been that we actually think that the best thing we can do in this environment for those customers that are eligible and we can help, and given the risk of further out of cycle rate changes being still persistent, if that bill rate stays where it is for a longer period of time, is actually give customers certainty for the next 1 to 2 years, depending on their preference, and actually offer them fixed rates that are at or inside our variable rate. It also is a relatively unique proposition. Most people charge a premium for fixed rate lending. Whilst we're not doing that for the long term, we know that our rate is pretty competitive. I mean, Ubank and TickTock are 5 basis points apart. Our process is much better. But, at the end of the day, what we're saying to customers is we'll give you that rate fixed for 2 years, no expense to you, and really just give you that certainty to see how this all plays out, and see whether that bill rate comes back, or whether ultimately, heaven forbid, down the track, you've stayed with the majors because of all the uncertainty in the market, and then suddenly when they do have the opportunity to exercise that market power the other way and start cranking up interest rates, they will.
Yes, thank you. And the release came out today, so I'll put a link to that on the blog so that people can see it. I think it's a really interesting move because, as you say, what you're doing is actually giving the prospect of more certainty to people in a very uncertain environment.
Exactly, and that's the objective of it. We talk about our low cost of origination. We're not immune to base funding cost changes, but we're able to, because of that low cost of origination, because of our technology, to offer customers that certainty at that price. So we'll do it.
Anthony, I really appreciate your time today. It's been a very interesting conversation. Thank you very much for sharing your views with my viewers, and perhaps we can catch up again in a few months' time as the industry evolves and develops. I think it's going to be an interesting ride.
I do too. Thanks, Martin, and appreciate it.
Thank you very much.
Cheers. Bye-bye.
Okay, cheers. So there you have it, from the front line, as it were. Very interesting observations from Anthony about the development in the market. If you like what you've seen here today, please like the post and share it. And if you have not subscribed, please do so by ringing that subscribe bell. And if you like what you've seen here today, also consider supporting us via our Patreon program. There's a link below. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.